Good morning, everyone. Welcome to our global market summary. Today, we'll be reviewing the week of May 17, 2026, focusing on our multi-asset strategy and macro analysis. Let's begin with a look at global asset performance. U.S. equities, as measured by the S&P 500, saw a modest gain of 0.88%, driven by easing inflation concerns and a general risk-on sentiment. Global stocks, represented by the Morningstar US, outperformed slightly with a 1.05% increase, propelled by dip buying in semiconductors and positive news regarding Mideast peace talks. Japanese stocks, specifically the Nikkei 225, were the standout performers, surging 3.14% to record highs, attributed to strong EPS growth and a lower PER. Turning to fixed income, the U.S. 10-year yield fell 3 basis points to 4.56%, mainly due to a drop in crude oil prices and revised inflation expectations. Crude oil, WTI, experienced a significant decline of 9.01%, falling to $96.14, following reports of a U.S.-Iran peace proposal draft. Finally, gold saw a slight dip of 0.31%, trading at $4,510, influenced by high interest rates and a strong U.S. dollar, but maintaining a strong floor at $4,509. Moving on to our macro landscape analysis, we see two major themes unfolding. First, in monetary policy, Kevin Warsh has taken office as the 17th FRB chair. Markets are now pricing in a regime change towards stricter balance sheet management and a more flexible approach to inflation targeting. The latest FOMC minutes clearly signal a hawkish bias, effectively removing expectations for rate cuts in the near future. Second, a geopolitical tug-of-war continues. Reports of a final U.S.-Iran peace draft, aimed at reopening the Strait of Hormuz, initially triggered a sharp oil sell-off. However, it's crucial to note that technical complexities, particularly around uranium enrichment monitoring, remain a key hurdle for any permanent resolution, suggesting continued volatility in the region. Turning our attention to the AI and semiconductor outlook, structural demand for AI infrastructure continues to drive market leadership. Despite some post-earnings profit taking in Nvidia, the broader sector experienced massive dip buying. Nvidia itself reported robust revenue of $81.6 billion, an 85% year-over-year increase, and announced an $80 billion buyback program. SoftBank also received a significant boost from ARM's impressive 46% weekly surge. From a fundamental perspective, Japanese PER has compressed to 18x, even as the market reaches record highs, indicating healthy valuations. Now, let's highlight some of the key equity movements this week. Our top gainer was ARM Holdings, surging an impressive 46.47%, driven by the surging demand for AI processor licensing. Birkenstock, ticker BERK, also saw a strong recovery, up 32.67%, thanks to robust earnings and a valuation rebound. Dell Technologies, ticker Dell, gained 21.98%, with AI server demand pushing price targets higher. On the losing side, Intuit, INTU, fell 18.59% after its quarterly outlook missed market expectations. And NIO Inc., NIO, dropped 14.75%, impacted by intense EV price wars and margin compression in the electric vehicle sector. In fixed income and policy, we've seen the FRB's hawkish bias re-emerge quite strongly. First quarter 2026 core PCE hit 4.3% annualized, and the FOMC minutes revealed that a majority of officials now support removing the rate cut bias. Money markets have completely priced out any cuts for 2026, with an 80% probability of an additional hike. Meanwhile, in Japan, JGB yields have spiked, with the 10-year JGB yield hitting 2.79%, its highest level since 1996. This follows PM Takechi's directive for a 3 trillion yen supplemental budget. Fears of fiscal expansion are now pushing long-term rates toward the 3.0% threshold. Let's examine the global yield matrix. For the U.S. 2-year Treasury, the current yield is 4.13%, up 4 basis points week over week, reflecting hawkish FOMC minutes and hike concerns. The U.S. 10-year Treasury is at 4.56%, down 3 basis points, driven by easing long-term inflation expectations due to falling oil prices. The Germany 10-year bond stands at 3.039%, down 6 basis points, influenced by a weak Eurozone PMI reading of 46.4. Japan's 10-year JGB yield is flat at 2.76%, but remains under pressure from fiscal expansion and supply-side risks. Finally, the Australia 10-year bond yield is at 4.922%, showing soft sentiment, primarily due to economic growth concerns and yield curve adjustments. Shifting to currency market dynamics, the USD-JPY pair continues to show resilience. The yen remains under significant pressure as Japan's core CPI came in at 1.4%, notably below expectations of 1.7%. The widening interest rate differential between the Bank of Japan and a hawkish Federal Reserve keeps the pair near the crucial 160.00 threshold. Concurrently, we observe continued euro weakness. The 5.0% service PMI hit its lowest level since 2021, at 46.4, significantly heightening recession fears within the Eurozone. Now, let's look at our FX range forecast for the coming week. For USD-JPY, currently at 159.10, we expect a range of 157.50 to 160.50. The primary catalysts here are low CPI data and potential intervention at the 160.00 level. For EUR/USD, currently at 1.1595, our forecast is 1.1500 to 1.1700, driven by the PMI slump and ECB financial stability risks. EUR/JPY, trading at 184.50, is expected to range between 183.00 and 186.00, influenced by the yield gap and potential verbal intervention from the Bank of Japan. Lastly, USD/CNY, at 6.80, is projected to be in the 6.77 to 6.83 range, primarily affected by China's slow recovery and ongoing Mideast geopolitics. In the right sector, capital efficiency is driving unprecedented consolidation with mega mergers. U.S. REITs showed a strong recovery in April, surging 8.90%, with data centers leading the charge at a 15% increase. A notable example is the $34.9 billion all-stock merger between EQR and AVB, creating a $69 billion giant with 180,000 units, aimed at scaling to mitigate high financing costs. Another massive deal is the $130 billion acquisition of Dominion by NextEra in the utility sector, strategically positioned for energy dominance. Let's discuss commodity defense. Oil experienced a significant geopolitical premium. While WTI initially fell 9%, it rebounded to $98 as Iran peace talks encountered hurdles regarding Hormuz tolls. The de facto closure of the strait continues to threaten 12 to 13% of global oil supply. For gold, we're observing an unyielding floor. Despite a strong US dollar, gold maintains a robust floor at $4,509. Allocators are finding it challenging to underweight gold, especially while key global transit points remain at risk. Our targets for gold are $4,576 as resistance and $4,441 as support. Looking ahead to the week, here are some key events and indicators to watch. On Monday, May 25th, both US and UK markets will be closed for a holiday, so we anticipate low liquidity. On Tuesday, May 26th, we'll get the US Consumer Confidence Report from the Conference Board, with a forecast of 92.5. Thursday, May 28th, will be a busy day, with the US PCE core deflator year-over-year expected to hold at 3.20%, and the revised annualized US GDP for Q1 also forecast at 2.00%. Finally, on Friday, May 29th, we'll see Japan's Tokyo core CPI year-over-year, which is expected to show accelerating inflation compared to the previous 1.50%. Thank you. Here are the sources for the images used in today's presentation.